Okay, so let's pull back the curtain right now on this number one millionaire money secret. And as we know, this secret is actually a strategy that we call the velocity banking strategy. So what is velocity banking? Well, for starters, it's a more financially efficient way for you to use your current income to maximize your cash flow, create massive leverage, and help you pay off your debts in a fraction of the time. And we're gonna be able to do this using tools that are available at the bank that anybody can use. You just need to know how to use them properly. And unfortunately, this kind of stuff just isn't taught in most schools, okay? And what are we taught? Let's talk about that for a second. What are we taught in most schools? We're taught the Pythagoras theorem, right? And how important this triangle is to your everyday life. I remember this, a squared plus b squared equals c squared. That's very important, right? They made sure that we knew this. But when it came to basic finance or things that are as simple as balancing your checkbook, they left this out, unfortunately. Okay, there is a reason for this. And Henry Ford said it best when he said that if people actually understood how this economic system works, there would be a revolution in a minute. A critical point to make here is that everything that you know about the banks, you learned from the banks, okay, inside of their mailings, their advertisements, their commercials on TV, okay? And there is a certain way that banks would like for you to think and act in order to increase their profits, okay? And so always know this, okay? Banks are in business to make money. So let's take a look at this, okay? Let's take a look at the traditional banking model that we are all taught. And for the rest of this video series, we're gonna be referencing the numbers here of the average American household. We put together this average American household scenario that we're gonna be using as an illustration, okay, to show you how this strategy works. So this is a hypothetical scenario to truly show you how this strategy works. So here's what we know, talking about the traditional banking model, is that in this average American family, we have $5,000 worth of income coming into the household, okay? And the traditional model is that whenever you get your paychecks, you immediately take them down to the bank. We have been programmed and wired to bring our money directly to the bank because they know what's best to do with it, right? We're gonna uncover this. But for us, what do? We bring the money to the bank, we cash the check, and we start chopping up that pie, right? And some of that money goes into checking, some of it goes into savings. And immediately when you look at this average American family, let's just chop it up right now. We have $1,200 going to a mortgage payment, which is attached to a loan. We got a 30-year fixed loan here, $200,000 mortgage, 6% interest rate. We got a car loan here, $600 car loan, $25,000 loan there, 6% interest rate. And we also got some credit card debt. The average American household has some credit card debt here. So we have a $15,000 line of credit, and we've racked up $12,000 balance on that card. Okay, so we got a 21% interest rate, $600 per month payment. From there, we got a $1,200 lifestyle here. So think about your phone, your cable TV, your Hulu, whatever it is, your phone, your food, stuff like that. And then from there, we got $1,400 left over that is typically just going to either A, go into the bank savings to be peeled off from throughout the month as you need it, or some of that's going to go into like an IRA. Maybe it's going into the 401k at your job or 529 for the kids, something like that, where it's not earning a very great rate of return. But either way, this is the typical banking model, okay, that we're all taught. And the biggest problem with this model, okay, is that we got $5,000 worth of income coming into this household, right? But every single nickel of it is accounted for, right? We got $5,000 coming in, but we got $5,000 going out every single month with expenses. We have zero cash flow in this model. And there's an old saying, and it's been said, that wealthy folks and rich folks, they're playing chess while everybody else is playing checkers. Well, what you're seeing on the screen here, this is your chessboard, okay? These are your moving pieces, and these are your moving pieces right here, and it's time to understand how these pieces work, okay, on your own personal chessboard. And this really ties in with how do banks make money? How do they make money from the model that we just showed you? What banks get to do is they get to leverage other people's money to make money. They get to do what's called fractional reserve banking, and you can take some time, you can Google search that. But a critical point to make here is that each time you pay the bank for your house payment or deposit money into your savings, that money gets turned by 10, and 90% of it is borrowed out again to somebody else, okay, at a higher rate of interest. And that's a little bit of a tongue twister. Okay, let me give you a critical example on this. And so when you have that $1,400, right, from our average example, sitting in the bank savings, the bank now has the ability to go to the Federal Reserve and get a loan for $14,000, okay, at a fraction of a point in interest. And now they have to keep $1,400 of that $14,000 on their ledger. So they have to hold on to 10% of it. But now, okay, they have that other $12,600 that they get to lend out, okay, to somebody else at a much higher rate of interest and make money. Okay, so banks make money by lending out money and charging people interest. And where did that additional $12,600 come from, you might ask? Well, it comes from thin air. Okay, it doesn't exist. Okay, it's merely a number on the bank's ledger. But just understand this, that this number puts more money in circulation, and the banks and the Federal Reserve are making money by charging us interest on nothing but numbers. And this is why, right, this is why banks always have the nicest buildings in town. They have everybody's money and they get all the leverage. And why is this a problem? Right? Why does it sound like I'm so fired up about this? Because it's your money, okay? And if anybody should be leveraging your money to make more money, shouldn't it be you, okay? Albert Einstein said this, compound interest is the eighth wonder of the world. Okay, he who understands it earns it, he who doesn't pays it. And that brings us back to our traditional banking model here. And now that you know a little bit more about how banks make money, okay, by charging people interest, now we need to understand a little bit more about our chessboard here and how these moving pieces work. Because our average American household example here, we have some loans and we have some lines. But what is the difference? Okay, well, we know that there is a difference, but what is the difference between a line of credit and a loan? Well, we will uncover that in the next training.